Scott, I think you're asking a good question. And what we've seen from the beginning of this bull market, you can look years back and say that the tech names, the digital platform, the communications companies drove the market higher. They outperformed on the way up. They outperformed on the way down. And in this recovery, the last 26% where the market has come back, they've also led. So I think that it's really playing against the odds to suggest that they won't continue to lead. What you're asking, however, is can the market go higher without participation from other sectors?
Well, not necessarily. I'm not necessarily asking that. I'm simply saying, Carrie, when you look at the market today, you can either hang your hat on this move in those tech stocks, or you can say, we may go back and test the bottom, or we could give up another 10 or 15 or 20% because the banks are telling you more to the downside than the tech stocks are telling you about the possible move to the upside.
Okay, so I believe that we're seeing this limbo phase. We're at around 2,800, right, up from 2,250 more or less. So we've made up more than half of the shortfall, that 33% the market fell. And the digital and tech stocks are telling you more right now about the market and expectations than the banks are. Part of the bank's problem, I mean, I think the biggest part of the bank's problem, it's interest rates. That was the problem before, and it's the problem now. You know, the whole economy has problems, as do tech companies. But if we go through this limbo, and even if the market treads water, what we need is to find out better sort of clarity on how we reopen, whether it's around testing, clinical trials, whether the Treasury program is working, what's happening in other countries like Denmark and Austria, where they are opening for business. They're opening their schools, and we've got to watch that. The market is watching that, but the market is very encouraged by what it's seen so far with intervention fiscally and monetarily. And we know there's bad news about unemployment. The market took that pretty well today. If the news means that we can open the country, I think that's positive. And if we can't open for a couple of months, I just think it's harder for us to trade higher. But I wouldn't dismiss what we've seen and the actions that the Treasury and the Fed have taken and what the market is believing the benefits of social distancing so far and compliance has been.
Yeah. Speaking of social distancing and stay at home, as we get into more of a narrative about what the reopen is going to look like in various parts of the country, I should let you all know, and you know that we track what Governor Cuomo in New York State has said about the numbers in the last half an hour or so. He does say that the stay at home business closure orders will be extended now by 2 more weeks to May 15th. And I wonder, you know, as we came on the air, you had certainly a better looking market picture than you do at this very moment. I wonder if we've just given a little bit back on that news. It's hard to know, and things have been a little bit volatile, even on each side of the flat line, if you will, in the Dow. But it's something to keep an eye on as we talk about this move to get back to business as normal. I also wonder, John Najarian, whether the bond market is screaming at the bulls in the stock market that you guys are way ahead of yourselves. And it's sort of what Lee Cooperman told us the other day, that the bond yields are telling you that there's severe economic stress. It's not just all of the stimulus that policymakers and the Fed and otherwise have done, that it is a true sign that there is weakness all throughout the economy, and the bond yields should be paid more attention to than perhaps where the stock market is in the next days and weeks ahead.
And maybe that's true, Scott. You know, the economy versus Wall Street. When we're seeing this right now, Scott, we're seeing the banks have basically had to carry an additional load because not only are they the conduit for a lot of these loans that go out, but they're not getting paid on a lot of loans when people are basically forbearance. They're stepping back and saying, I can't right now, and we understand why, but that's why that sector is just so weak right now. And yet you look at a lot of the stocks that you named, FANGs in particular, and FANG Man at the top. Well, those stocks, those tech names, Scott, are driving higher because they're not as dependent on that, and the government hasn't used them as the conduit and hasn't, with the shutdown, they've benefited in some cases from that shutdown. I mean, clearly Amazon, Netflix, Target and Walmart they'd love to have people in those stores as far as Walmart and Target, but they've also seen a dramatic move as most of us have had to buy so much of our stuff online. So, you know, on the one hand, you've got the banks that are carrying an additional burden, and you've got these others that are getting a lift from a lot of the spending that goes on because it has to through those measures.